Okay, last 1 hour of trade and what is turning out to be a very eventful day of Indian markets. Eventful because same time yesterday there was tentativeness, there was nervousness, but there was very little excitement. Today we started with a bang. It expected that we would be in for a good day, but the opening session turned out to be almost the highest point of the day, 12 o'clock, and the trends have changed. Europe opens, no follow-up buying, markets they corrected. So are we at that curve where in the near term, when I say not near term, short term, 50 to 25 200, 25 300 will now become more like a glass ceiling because markets have gone that not once, not twice, but for the third time in last 1 month, and they've come down. So Kunal, in the morning, it appeared that we could be in for a good day, 30 trading sessions of flat trade, and look like by the end of the day it could be 31, even though ये 30 का महीना है.
31 trading days.
Trading
so
days,
that's
yeah.
almost like 1.5 months.
Yeah, and there must be some holidays also in between.
Yeah, that's
so it's almost 2 months.
But that's the way the markets have been. I think the last 1 hour or so, there has been some choppiness, some volatility which has come back again into the index. In fact, at one point of time, just about in the last half an hour or so back, the India VIX had shot up back again to that 14 plus mark. It's now ebbed off sub 14 levels. But then that tells you that the markets were a little bit more jittery with whatever the kind of news flow which came out. The only point which I think one should be looking out for is strong sector trends, because only then I think we can probably establish that the markets are coming back into a breakout zone, and then we are looking at a trend on the upside. So the markets generally don't like this kind of a 200-point gap up and then an intraday correction or then a comeback again. I think even if we have like a 50-point, 70-point kind of a day for the index, but if it's more gradual and sustainable over the next couple of days, that itself could be very cheerful for the market. So we need to see a point where over the next couple of days, once the news flow starts to ebb off, does the market or the indices hold on to that direction on the upside or not?
Okay, so that's the strategy going ahead, and important factors to watch out for in the sessions to come. But if you take stock of what the market is up to right now, you have Nifty 50 that's trading with gains of just 0.3%, a big cool off coming in from the day's highest point. In fact, we're almost very close to the day's low when it comes to Nifty 50. We've maintained the position we have on the green, but looks like the bulls are selling some position that they have held on to quite patiently since the market was tumultuous over the last couple of trading weeks. Other than that, you have Sensex that's up 0.2%. India VIX has cooled off by another 1%, so 13.914 thereabouts is where the India VIX is right now. Nifty Bank 0.6% higher, so at least this pocket, the banking space, is showing some resilience in today's trade. The broader end of the market also has simmered down from the day's highest point, but the mid-cap and small-cap, they continue to trade in the green, so there's not much to complain about on that front. Sectorally, like I mentioned, private banks are doing well, but other than that, Nifty PSU Bank also is the top sectoral gainer in today's trade, followed by metal, auto, bank, FMCG, realty, pharma, energy, and IT in that pecking order. Today, what's not doing well is surprisingly the sector that was outperforming the market yesterday, and that's Nifty Media, the only sector that's in the red right now. But Kunal, what are you making of the move that we're seeing in the banking index? Even though the benchmarks are trading with gains of just 0.3, Nifty Bank is looking slightly more resilient. PSU banks are outperforming the market.
Yeah, PSU banks and I think few other large cap private sector banks are also, they are playing their own part. Then I think that's how the texture of the markets was, because we were dependent on the banking and the financial services index broadly for the last many months, and I think they've managed to stand tall whenever the markets required them to start going to that zone of outperformance. But the question again Sneh, is that whether there are other sectors which can participate in the same kind of a manner or not for the index to move up higher, because over dependability on one sector could probably lead to just about a very different kind of a skew from for the overall market bent. Because then there would be a point where the market breadth would underperform significantly, even if the benchmark indices move up higher, because then we'll be solely dependent on one of the key private sector banking name or the bank Nifty as such to start outperforming. So that's the concern which the markets are facing right now, and that is why I think you're seeing that whenever the index comes closer to that 25,200 mark, we are not seeing that kind of a firepower which generally happens when the markets usually come back into a resistance breakout.
So Kunal, you failed this point for 3 times now?
Yeah, three times.
So which means if you fail the upper end of the range, you'll rush to the lower end of the range.
Yeah.
That means the lower end of the range will be tested again, or this would be a day. So what is the pattern here? One pattern is higher resistance to lower resistance. Market keeps on oscillating between that. That's one trend. Second is that we failed to cross 25,200, but we are unlikely to go and retest the recent lows, and we may just hang in there.
Correct.
So are we likely to retest the lows, or are we likely to hang in there?
I think we should be hanging in there. So, what this tells you also, Nikunj, is that if the markets are unable to scale past above certain resistance level, it's not ready for a breakout.
It's a matter of time or weakness.
It's not strength, I would say.
No, it's a matter of time we'll break the resistance, or this is inherent weakness which will just make the market very thanda.
This is lack of strength, Nikunj. So, not to put it into a weaker tone, but lack of strength is why? Because you don't have sector trends participating. And, till the time you don't have, strong leaders emerging in terms of individual sectors, it becomes very difficult for the markets. You will have those intraday breaks of 25,200 and, those kind of levels, but they will not be sustainable.
Okay, so that's the take on the market. Let's move away slightly from the equity market and tell you what's happening on the bilateral front with US. While sources say India-US deal is in trouble, Finance Minister Nirmala Sitharaman said that deals with both the US and EU will likely be concluded soon. But India is also on the lookout for newer export destinations. As we slip into a very short break, listen into what she had to say.
I appreciate the Indian exporters putting that kind of an effort, that they are still growing and are finding real success. And with the US and the European Union, negotiations are really intensely going on and should come to a conclusion sooner. So emphasis is being made for getting more free trade agreements signed. Apple's India's iPhone contract manufacturers have crossed 20% domestic value addition.
Hi there, welcome back to Closing Trades. Let's shift focus and talk about what's happening in the railway space. Your train journeys may soon get a little bit costlier according to sources, as the ministry is planning to hike prices based on the class and distance travelled. Samir Dikshit, my colleague, is joining in with more details on that. Samir.
Yes, definitely. That's an important development in the railway sector, that the Railway Ministry is actively considering the proposal to raise the rail fare slightly. If you talk in terms of the quantum, it is very less, but yes, there is an active consideration to raise the train fare or the rail fare. So what we are picking up from our sources, that the file has already been prepared. It is being discussed by the top ministry officials and also by the Railway Minister. As of now, there are different kind of formulas that are being discussed or considered. For example, there could be a formula that could be adopted, that the fare can be increased on per kilometer basis. For example, 1 paisa per kilometer can be adopted. So if you are traveling to a distance of like 500 kilometers, so average, if you see, rupees 5 could be the fare that could be increased if you are traveling from 0 to 500 kilometers. So per paisa per kilometer, that could be the formula that can be adopted. But if you see, the base will be that based on the class, the AC first class, AC second class, or the AC third class. So based on the class and the distance travel, based on these two factors, the rail fare can be increased. As of now, there is no consideration to increase the rail fare of the suburban trains. So that is also an important point. But largely, the Railway Ministry is looking to raise the rail fare in coming days, and by this move, the ministry understands that they will not be able to actually burn the pockets of the rail commuters very much. It will be a very slight increase, but yes, this will help the railways to generate a significant amount of revenue, and this amount can further be utilized to improve and enhance the railway infrastructure.
So Samir, if I'm traveling from Mumbai to Delhi, which I'm planning to travel soon, how much more will a second class AC Rajdhani ticket change for?
Sir, so basically, if you're traveling from Mumbai to Delhi, suppose that is a 1500 kilometer of route length that you are traveling, and per paisa, 1 paisa per kilometer, if you calculate it, then roughly around 15 rupees or, it will be somewhere around 15-30 rupees that will be increased. if you're traveling on second class, then it could be of somewhere around rupees 50. So that formula is being discussed as of now, not a final approval, but that formula is currently being discussed. That suppose you're traveling through Rajdhani train, then definitely it will cost slightly higher than mail or express train. Because one important point, let me add over here, that Rajdhani train or the Vande Bharat trains or Shatabdi train, they also have dynamic fare pricing mechanism as well. So in these class of train, the fare increases with the bookings of seat by each passing hour or when the train departure time comes closer. So dynamic pricing is also applicable on these premium trains. So traveling on these trains will get costlier a bit more than mail or express train. But the formula which my sources are telling that it could be that per 1 paisa per kilometer that could be adopted. As of now, it is being considered, and final approval we might see very soon.
Kunal, there is one catch here. Without ticket. If somebody travels without ticket, फिर क्या होगा? कुछ नहीं फर्क पड़ेगा.
But then I think he'll be penalized.
पता नहीं whether the new fare would be charged on it or old fare would be charged on it. That is the point I'm saying. That is a tricky part. Okay, Samir, great story. Sunil Kaul is ready. Head of Global Emerging Market Equity Strategy with Goldman Sachs. Sunil, nice to have you back. Sunil, you were bullish at a time when there were uncertainties or concerns in the world. Tariff war, high FI selling, uncertainty around earnings and slowdown in government spending. Now, one by one, block by block, all the concerns have got addressed. So what is next for the market? Are markets pricing in all the good news?
Look, I think, Nikunj, just to put things in context, I think we had been positive on the Indian equity market, but we also downgraded the market back in sort of September, October last year because the market had done well and we were kind of going through this slowdown in growth and slowdown in earnings. And we had been in that downgrade cycle, right? And obviously, I think from the April lows, not just India, but the global markets have done fairly well. So India has rallied also. And a large part of that is because of the relief around tariffs, right? But you're right. I think if you incrementally thought about what the worries we had coming into the year, a lot of those are behind us. And I would say, look, incrementally, I would say we have been more positive on India. We have been sort of more fundamentally sort of getting more sort of positive. And I think a large part of that reason is because we think this large sort of downgrade cycle we had been seeing in earnings for the last 9-10 months in India is now sort of bottoming out already. We're actually expecting earnings to pick up in the second half of the year. So we are sort of therefore turning much more constructive, even on the India's domestic cycle itself. As you mentioned, things are obviously moving in the positive direction, especially with the policy, with both sort of central bank as well as on the liquidity front. And obviously global environment is also looking better. So I think things for the equity markets globally are looking better as well as India. But for India, I think the only concern we have is on the valuation front, which is why, given it's still quite expensive and markets have rallied, which is why I think at the headline level, we have a more modest upside for the overall market, more looking like high single-digit returns for India, lesser than some of the other markets we cover in emerging markets. So we are kind of market weight overall, but directionally we do think that earnings are going to pick up, and if the market does deliver sort of 11-12% earnings growth, which is what our estimate is, the market can make sort of further gains into the next 12 months is our view.
So where do we go from here, Sunil? What will influence the script? Will it be tariff? Will it be valuations? Will it be flows? Because first 6 months have been volatile. Next 6 months, which is the second half, will it be rewardful, no returns? How do you see the second half of this calendar year moving?
Look, I think we will see earnings cycle picking up, but the market's already priced some of that in. So I think in terms of absolute upside, Nikunj, as I said, you probably are looking at 5-6% upside. We have a 26,200 target on Nifty, which is sort of a moderate upside. But then because valuations are expensive, you probably have a catch up of earnings catching up to the overall market, but the alpha is more beneath the headline index. So I think there is still a lot of the thematic pockets within the market which are recommending people to buy into, as opposed to buying the headline index in here.
This is Snehi also joining in. Last time when we interacted with you, almost a quarter ago, you did say that it seems like domestic growth has bottomed out. If you take a look at the macro scenario right now, it's a whole different story in terms of CPI, GDP, our PMI numbers latest. They've all been very supportive of growth. In this backdrop, with respect to these macros, what's your growth outlook ahead?
Look, I think the Q1 numbers, you're right, have been stronger. I think the higher frequency data has been sort of also improving, which is why we have sort of touched up our growth numbers a little bit. So we are looking for sort of annual GDP or annual GDP growth of 6.6 for India. So I think that's a reasonable number, especially if you look around the world in terms of growth backdrops. India continues to be one of the strongest, or actually the strongest growth economy, large economy out there. So we are positive on the growth cycle. Therefore, I think the difference only is I think we have a much stronger preference within different segments of the economy. We think the leg of the growth recovery will be driven more by the consumption recovery rather than sort of investment cycle recovery. And so we do sort of therefore advocate people to be more focused or positioned in the consumption oriented sectors in the economy as opposed to infrastructure heavy sectors. But we do, to your question, we do think growth has kind of bottomed out and growth is kind of recovering from current levels.
Hold that thought. We just need to slip into a time bound commercial and we'll be right back and we'll continue this conversation with you on the other end.
I'd like to just mark the markets right now because there's a teeny mini recovery, just like 5, 7, 10 points from here and there, but that is inconsequential. Sunil, what is your view on the way how the geopolitics is moving? I mean, first it was India and Pakistan, then it became Israel and Iran, now it is Israel, Iran and America. Before we started reading the war history, there is a ceasefire. From a market standpoint, these are events which have historically marked volatility, spike in volatility, spike in VIX, spike in crude, spike in gold. In this kind of a volatile environment, why are equities not panicking?
Yeah, look, I think you're right, Nikunj. I mean, to a large extent, I think if you looked at the tariff risks, which everybody was kind of focused on coming into the year, many of those haven't sort of materialized, right? Obviously, we have sort of put a lot of that on pause. And I think the market has therefore kind of looking through many of these shocks so far. And I think in general, the other theme which is related in here, because as you mentioned, equities have been doing well, but I think the other theme that has been supporting this, and that's kind of resonating with a lot of our clients, is this theme of sort of diversification. The idea that people over the last 10, 15 years have kind of overinvested in US assets, not just US equities, but kind of treasuries and US dollar. And given all the geopolitical volatility and events, I think there is need for people to diversify. And so we sort of saw that play out with people kind of moving money out from US to Europe, and European markets have done fairly well this year. And so a large part of that, I mean, there was a bit of sort of fiscal expansion story in Germany and other parts, but a large part of that was now flows moving back to Europe. And now I think what we are starting to see is that trickling down to the emerging markets as well, including some of that in India. And so I think there is higher uncertainty, but equally speaking, I think there's kind of more rotation of money and flows coming back into the emerging markets after like 10, 15 years of underperformance. And that at the margin is also being supportive for equity performance.
Okay. There are 2 or 3 moving parts. One is the local moving part, banks connected with interest rates and liquidity. The other moving part is IT and pharma connected with global strength, rupee and dollar. And then the third moving part is the consumer staples and durables, which are linked to consumption, interest rates, inflation and monsoon. Which to your mind is the most exciting moving part for you out of the 3 parts I mentioned? And which to your mind is the boring part?
I mean, look, we have sort of clear, strong views around that, Nikunj. So as I said, I mean, financials, we had been sort of more market weight to cautious over the last 18, 24 months. Obviously, even though Indian equity markets did very well, they did not participate. And I think a large part of that was because of the macroprudential tightness from RBI. And then I think coming into the year with the February policy meeting, we did see a U-turn in policy and we have become more positive on financials. We have actually upgraded recently financials to overweight. And the reason was that we think, obviously, with RBI being more supportive in terms of liquidity, we think banks we think sort of visibility on banks is much better. I mean, obviously the front loading of the rate cuts and signaling the end of the rate cut cycle means that there is more certainty around the path on NIMs. And we do think as liquidity improves, you could see demand picking up and loan growth picking up, and that should mean better performance for banks. And obviously, we all know it's still one of the more cheaper part of the overall Indian equity market. And so we are quite positive on financials, both NBFCs and banks. So I would say that's where I think the highest sort of positivity is. Then I think consumption, as I mentioned, so we do like pockets of the consumption recovery. We are actually overweight autos. We do like staples and select consumption discretionary bits, especially around the QSR and the tourism theme, which we think is kind of a more structural theme in India. So there are pockets of consumption we do like. I think some of that will start to perform better as we head into the festive season, depending on how monsoons and sowing look. So far, I think things are moving in the right direction. So I would say I think financials followed by consumption, and that's where we are overweight on. We are more cautious on the broader infrastructure segment, sort of cement, real estate, industrials, those guys, and so a clear kind of divergence there. We are more neutralish on the export-oriented sectors. Obviously, we were more cautious with the slowdown in US and the tariff risks, but given a lot of that is getting priced out, we have neutralized the views around IT and pharma. I think at the margin, pharma still has a bit of policy risk because you could potentially see some sectoral tariffs come through in the pharma space. So that still remains a policy risk in that space. But I think IT is a little bit more cleaner, given sort of more cleaner balance sheets. And so, but we are relatively neutral on IT. And so I would say financials followed by consumption, and the last one would be IT in the pecking order.
Okay, so that's the pecking order. That's the way Sunil is positioning his views at the moment. And Sunil, thanks so much for joining us, and thanks for giving us your time. On that note, we'll let you go. But let's welcome on board Vinay Rajani, CMT, Senior Technical and Derivative Analyst of HDFC Securities. We have Kunal also who's joining us. Vinay, I'll come to you first. Give us your reading of the market move that we've seen today. We've started with a bang and we've completely flattened out from there, although resilience still continues to be in the broader end of the market. Do you believe this trend is here to stay, this outperformance of broader markets?
Good afternoon, and thanks for having me on the show. So yes, today it was on Nifty was almost 350 points up, and in the first half it was holding very well. But unfortunately, after the second half selling, we can say that we are still into consolidation. So on closing basis, we need a breakout, but it is not coming. 25,200 happens to be the very strong resistance, and that should be taken out on the closing basis. That is not happening. And obviously, there are very news flows are coming, and on the basis of that, volatility is emerging. But overall, if you were to see for last 6 consecutive weeks, Nifty is into consolidation and market is not getting any momentum and direction on the one side. But primary trend is still bullish after today's selling from the higher level. We cannot say that it is a negative pattern or bearish reversal pattern. Still, we can say that tomorrow could be another different day, and we may again resume the uptrend. But unless we get out of this range on a closing basis, we cannot give any directional view. So waiting for 25,200 to be taken out on closing basis. On the downside, I see a strong support around 24,700, close below which definitely will increase the chance of the breakdown. So that is the stop loss, and I'm suggesting for the traders that 24,700 is a very strong support. Unless that is breached, we can expect again in the next coming session resumption of an uptrend. So yes, down, but we are still not out, we can say, going by the trend.
Well, down but not out. What will make us out and what will bring us in again?
What will make us out, of course, with the slew of negative news flow, if it starts to deteriorate further. I think July first week as it is the the day for the markets where there would be a lot of expectations in terms of tariffs. So maybe that could be another trigger which the markets would be watching out for. What could move the markets higher, I think, and that purely is when you see strength across 2 or 3 major sectors emerging back. So, for example, banking stocks, financials, that remains to be the top heavy-weighted sector. Then you have the IT stocks. So far, I think the IT stocks in the last 2 days have just about gone into a bit of a disarray in terms of the price performance. Maybe that has to start looking a lot more attractive. And then the mid cap in the market have to start going back into a zone of a very strong breakout. So there have been individual stocks which have shown signs of good price action, good volume action, but then there is either lack of follow through or the move doesn't trickle into the other sectors or other stocks within the sector. So that's the other concerning part.
It's interesting, Sain and Kunal, that 9th of July is when the tariff window ends. And with all the yes, no, I don't know, deal, no deal, deal round the corner, final stage, nothing has come so far. And now we are getting dangerously low to what could be called as this entire suspend impact. So it's a matter of maybe a week or certainly post in the first week of July, markets would say show us the deal. The deals may come in the 11th or 59th minute or maybe 1 minute after the 12 o'clock strike. But somewhere the so-called Cinderellas of the world, they will start getting worried. Why? Because the markets right now know that there is a deadline which is at play. So this is something which markets are taking for granted. But and these deals are complex deals and deals are centered around currency. Because the deals between India and between US and Japan will only be successful if there is not tariff but also view on currency. China deal only will be, China let's say appreciates the currency. Then the deal is of no sense. China does not appreciate, China depreciates that currency, not depreciates the currency. The deal is of no sense. So that is something which we need to start thinking about and start talking about. I'm surprised nobody's talking about it. So I think if you're asking me for a risk, I think that is an unobvious, but unintended, but it is more like a event which we need to now start talking about. Chakri Lokpriya, would you like to talk about it? Good afternoon first, and then your comments.
Yeah. Good afternoon, Nikunj. It's a very important topic that you raised. Going by the right from April 1st onwards to now, the various goalposts have been changed by the U.S. government. So July 9th, I believe again will be a goalpost that can be changed. Because like you rightly mentioned that this is very complex negotiations out, and a number of countries are bilateral agreements with each other. India with UK, India with EU, India with US, and like that, so many permutations and combinations. So I think for the US, they need deals really with only about 18 countries, which are significant to the US. But it's unlikely that going by what has happened in the last 2 months, that they'll reach any kind of a deal, and each country will get its own extension. I think that's where we're headed to, and therefore the market will be waiting, watching for until each thing happens.
I just feel like talking about cement right now, and just hold your breath here. We look at 10-year charts here. Something, sometimes good to talk history. 10-year chart of Ultratech, 10-year chart of ACC, 10-year chart of Shree Cement. Kunal, tell us. 10-year chart of ACC, 10-year chart of Shree Cement, 10-year chart of Ultratech.
So I think ACC, for example, that stock 10 years back was around 1500. Okay. Right now it's at 1850 thereabout.
So ACC in 10 years has not given you any return. Yeah. Even the Holcim was owning it, which is one of the biggest and the most efficient cement company in the world. And Adani has been owning it from 3 years now, almost 3 years now. So all that assumption that, okay, big corporate groups have come in, efficiency would kick in, it's not worked out. Let's look at Shree Cement.
Ultratech Cement, that's moved from 3,000 to now 11,500. So it's almost
which is not
4x.
Which is like slightly better than markets.
Yeah.
Slightly better. Now let's look at Shree Cement. And Tino Cement, same cheez.
Yeah. Shree Cement from 10,000 to almost 30,000 right now.
Yeah. So just think about it. I mean, how underperforming cement stocks have been. How much they have underperformed, even though the GDP in 10 years has gone from 2 trillion to 4 trillion. Real estate is in a bull run. Road is in a bull run. Capex has done rather well. Infra has done rather well. The roads and everything has done well. The sector has seen massive consolidation. Smaller players have got out. Ultratech has just about bought every small player, and ACC and Ambuja have bought the remaining players, and the players which are there now have such small capacities that they cannot call pricing power. I think Dalmia Cement also has gone through an M&A. They've taken a Capex change. So the mystery of cement continues. Chakri?
Yeah, you raised a very good point, Nikunj, which is if you look at cement companies in the last let's say 7 years or 8 years, they've had hardly any pricing power. Their price increases at best have been way below inflation. And, thanks also every now and then the government saying that, oh, the cement prices should not be increased. And second, because there was competition, now you have two large players. But that's another reason which contributed to the lack of this market beating returns for cement as an industry. Now we have to see with Ultratech and ACC, becoming the two large players, whether they'll show some signs of pricing power.
I appreciate that view. We'll slip into a very short break and we'll talk about the last 15 minutes of trade and keep the discussion going with our experts on the other side when we return. Hi there, welcome back to Closing Trades. Now, in light of the recent geopolitical developments that have been taking place, a lot of conversation has been centered around crude, but we also need to focus on a very important crude derivative, that is fertilizers and chemicals, because remember, Iran's biggest export to India is chemicals. Now, the government has reviewed fertilizer availability amid ongoing Israel-Iran tensions, and the ministry has found sufficient stock and supply chain to meet current demand. Prakash is joining us with more details on this. Prakash.
That's an important development coming in, as we're learning from our sources that the government has reviewed fertilizer availability amid ongoing Israel-Iran tensions. A very significant development coming in. Our sources are indicating that the issues such as supply chain availability, pricing and transportation costs were discussed, and Ministry finds sufficient stock and robust supply chain at this point of time to meet domestic demand. A very significant development coming in. Along with that, sources are also indicating that there is no immediate concern over availability of NPK category fertilizers. In fact, Ministry has asked the companies to ensure sufficient import to meet domestic demand going forward. But the pricing remains a major concern for the companies at this point of time, as NPK category fertilizer prices have witnessed a significant rise in last 1 month. In fact, raw material prices have increased by almost 13 to 15%. When it comes to DAP prices, it has seen significant surge as well, where DAP prices have increased by more than $150 per ton in last 3 months. Therefore, pricing remains a major concern for the companies, but the ministry has urged companies to make sufficient import to meet domestic demand, and a government will offset the increased cost by increasing subsidy allocation going forward. A very significant development coming in. The process has been initiated and these efforts are being made to ensure sufficient availability of fertilizer at affordable prices. Back to you.
All right. Interesting. Chakri, what's been on your shopping list of late, and where are you looking at taking some chips off the table?
Clearly, everybody's favorite is ours too, which is banking has done well. I think it will continue to do well. The valuations are in its favor. All those things that RBI has done, cutting rates, 100 basis points, liquidity, reducing provisioning, all these help. And still, banks' valuations are still very reasonable. So what is needed to take these banks up is, with all these actions, hopefully the earnings for corporate India will bottom out and start picking up. On the other hand, the companies like railways, which used to be so boring a couple of years ago, have become so attractive at their growth potential. Titagarh is now talking about a 35% plus revenue growth. And these are real orders and the multiple sources of orders. And, defense is done phenomenally well. We all know that. Still, there are pockets of defense, because now defense has become such a fashionable theme worldwide, whether it's Bharat Electronics or Data Patterns. These companies are still valuation-wise okay to their order book.
Data Patterns, again, just one of those stocks which has just hit out of the roof. Where is leadership in this market, Kunal? We're trying to understand that.
In terms of sectors?
Any stock also. Reliance showed a lot of promise, but then last 1 month it's just gone thanda.
In fact, the major reason for the index falling down today, Nikunj, was Reliance Industries, because that stock I think ebbed off some 2%, 3% from the intraday highs. So I think what we can, we did a sector-based analysis on how the indices have moved in the last 25-30 days. of this consolidation, which are the sectors which have actually done reasonably well. So one of the sector, of course, is banking financials, which has started to look attractive. They've done reasonably well. From the other sectors, media is something which has been looking attractive. I think Z Entertainment, there are a few other names from the media pack which are looking attractive. Of course, they don't have any major weightage on the index as such. From the other sectors, you had defense stocks, which or PSU themes which had largely done very well. Many of these defense stocks and the PSU names had come back to their, I think multi-month highs. Some of them are already at multi-year highs for themselves. So these are the only set of stocks and sectors which have actually looked very attractive.
Okay, so that's the take from Kunal, but time now to get in some BTST ideas. We'll come to you, Vinay, first. What's looking good on a BTST basis? Where would you be placing your bets?
Yeah, so I would pick a stock from the FMCG space. After a long time, we can see some strength coming back, and FMCG is a sector which has not participated well in this entire year. And I think I see some oversold territory in some stocks. Dabur has reversed, so Dabur India looks good for the BTST or 1 or 2 days trade. 474, 475 should be the entry. 465 should be the stop loss on the upside. I'm expecting a target of 490. Second pick, I would take it from the fertilizer and chemical space, which is Chambal Fertilizer. It has witnessed a sharp fall from the higher levels, and now it is trying to find support near its 200 days exponential average and bouncing back. So Chambal Fertilizer can be looked at 562, stop loss can be kept at 550, and on the upside, I'm expecting a target of 580.
Fall of 1%, 250 points, off from the day's high, below 25,200 but above 25,000. That is the construct of the market. You may look at the market from the day's high and say, okay, we were hoping for a breakout, it has not happened. But you look at the market in totality where we were yesterday with crude at $80, I think the markets have done well for themselves. And I am optimistic. It's a glass half full approach which you should have in this market, Kunal.
Yeah.
Glass half full approach is a better than glass half empty approach.
Yeah.
So what, we've not crossed 50, 25, 200. So what?
No, Nikunj, you look. Of course, you look at it in this manner. In the last 2-3 months, we've almost negated of the pain the markets had seen in the prior 5-6 months of a major correction. From September 2024, it was small caps, mid caps, large caps. Nothing was spared. And then in the last 2 months, from I think March or April first week somewhere, is where we've seen the building blocks from 22,000 marks up 22,000 levels, for the index to come back to 25,000 mark, stay at this level for the last 25-30 days, even at a point when there has been so much happening across the geopolitics as well as the global news front in terms of tariff, etc. So that, I believe, is a win-win situation for the market. So if the markets have that capacity to digest so much of happenings across the news flow, global, domestic, etc., and still stay at a particular level, that itself would be considered as a win-win situation for the markets.
When you look at the weather app, it says the temperature is at 34 but feels like 36. That is the market for you. We may not be at an all-time high, but a lot of stocks are making you feel that the correction never happened. In the month of May and March, the ugly correction what we saw, that is now history. So sometimes the temperature does not give you the accurate feeling of how are you feeling. The Nifty today is not giving the accurate feeling of what is happening in the broader market. I think that is, for me, the punchline. Vinay, let's get a closing comment from you also on today's market action.
Yeah, so as you said that we have come down from the higher level, but the view should be we should take an optimistic approach as we are closing for 25,000. And as far as broader market is concerned, still more than 50% of the NSE 500 stocks are trading above their 200 days moving average, and more than 74% of the stocks are trading above their 50 days moving average from the NSE 500. So broader market is still bullish, we can say, positionally. It's just that we are passing through the consolidation, waiting for the breakout to come. But till yes, selective stocks can continue to do well, and 24,700 should be the stop loss in trading norms.
I appreciate that view and appreciate you joining us along with Chakri and Kunal as well. With that, I'll hand it over to my colleague Ashesha, who's waiting by with a roundup of what today's trading session has been like. Ashesha. Well, yes, Nehi, we gave up all of those morning gains by the end of today's trading session. Nifty is ending 95 points higher, 2570 is where the Nifty is currently trading, up about 100 odd points. Nifty Bank should also come up for you on your screens. This one was also gaining nearly 430 points in today's trading session, 0.8% higher for Nifty Bank. Broader markets were also gaining in today's trading session. Nifty Small and Mid Cap Index on your screens. Small Cap Index up 0.7%, Mid Cap Index also ditto in line. In terms of individual stocks that were gaining in trade today, Adani Ports, this one was up about 2.5% today. Some management commentary that came in from the group's AGM, the stock was up 2.5%, the biggest gainer on the Nifty 50 index, followed by Jio Financial and Shriram Finance. These were some of the top gainers from the Nifty index. Adani Ports up 2.7%, Jio Financial Services also up in excess of 2.5%. In terms of individual sectors, we had PSU Banking Index, which was bucking the trend in today's trading session, up nearly 2%. We had Union Bank, which was up 3%, Canara Bank, Indian Overseas Bank gaining anywhere between 2 to 3 odd percent. This was followed by Nifty Metal Index, which was gaining in excess of 1.5% in trade today. So we had the likes of SAIL, Welspun Corp, Hindustan Copper, all of them gaining in trade today. Let's talk about individual newsmakers then. We had Jindal Steel and Power on the back of Nuvama Road, where they're maintaining their buy stance with a target price of 1193. We had JSPL, which was up 1%. Vodafone Idea, several news pieces over here. One Economic Times report which suggests that the centre is looking to give relief of about 84,000 crores worth of dues. The stock was up 5%. Delivery, in fact, the stock on the back of capacity expansion plans that the company announced, the stock is also holding up nearly 5% in trade today. TVS Motor, they launched their new product, Titagarh Rail Systems, on the back of an antique report where they are maintaining their buy stance on the stock with a target price of 1,099. So Titagarh Rail also ending the day with an uptick of nearly 6 odd percent. We had Delivery, as I mentioned, on the back of their capacity expansion plans. Coupled with a report from JM Financial, they are maintaining the buy. 480 rupees per share is the target price, 4.5% or rather 5% uptick on Delivery. KPIT Tech, they came out with their mid-quarter update with respect to the deal pipeline, which continues to remain very strong. KPIT Tech, however, they say outlook in US and Asia continues to remain uncertain, because of which the stock tanked nearly 6% today. We also had a whole host of oil-related companies in focus because of the fall that we saw in oil prices overnight. We had HPCL, BPCL, IOCL and several other oil refiners that were in focus today. But all in all, we gave up all of those morning gains, but despite that, ending the day in the green, in line with what geopolitical and global markets were suggesting. Nifty is ending near that 25,075 mark. But that's all the time we have on this edition of the show. More news and updates coming up on the other side.